for a market to begin moving, there has to be what we call impactful volume. And impactful volume is another way of saying demand is greater than supply or supply is greater than demand by a lot and overwhelms the other side, and the market then moves. The three universal laws of volume, otherwise known as the three universal laws of supply and demand, which was created by Richard D. Wyckoff. So first of all, who is Richard D. Wyckoff? Richard Wyckoff is considered to be one of the grandfathers of technical analysis. He was born in 1873 and he passed away in 1934. But one of the interesting things about Wyckoff was, one, he started working as a stock runner at the age of 15 and went on to become a noted trader and tape reader. But in addition, he was also able to study and interview and work with some of the top traders of his time, including Jesse Livermore, E.H. Harriman, and James Keene. And so he not only was a trader of his own, but he got to learn from the best of the best. And he developed some principles that relate to volume that are still in use today. They're a classic example that certain principles are timeless, regardless of what market you're in, regardless of what the economy is doing. The average retail trader has very little access to flows. So we have to focus on what we can get. And what we can get is volume. Volume is equal opportunity. It has to be put out and reported, and it's out there for everybody to see. So for us, volume is the thing that we need to focus on. Well, today we're going to talk about these three universal laws of volume. They're going to help us to understand what volume really is and how we can interpret it. Let's go through it. Law number one is the law of supply and demand. Price moves are governed by the relationship between supply and demand. So in other words, prices move based on supply and demand. When demand is stronger than supply, well, of course, then price is going to go up. When supply is stronger than demand, well, then price is going to go down. And when they're balanced, prices are going to move sideways. They're going to consolidate. They're going to create a congestion. They're going to just drift back and forth. This starts to create the relationship that we use, that we can combine price with volume to be able to understand whether a move is likely to continue or likely to fail. This is one of the things that we talk about in our classes. For a market to begin moving, there has to be what we call impactful volume. And impactful volume is another way of saying demand is greater than supply or supply is greater than demand by a lot. So we're in a dynamic where the market is sideways, consolidating, and then big buying comes in, demand. Or big selling comes in, supply, and overwhelms the other side, and the market then moves. Now, this brings us to number two. The universal law number two is the law of cause and effect. The magnitude of a price move is determined by the preparation that precedes it. So price movement is the effect. It's going to be proportional to the cause, which is the amount of accumulation or the amount of distribution. Another way of saying this is that the longer and deeper the market has congested, the larger the potential move. And this is because the longer that a market congests, the more and more participants withdraw. They're bored, they have no interest. And so as a market starts to have participants withdraw more and more, if something changes, they all have to get in, and that causes these elongated moves. A market that gets really quiet, that consolidates and gets really quiet, is a market that's moving into a contracted state of volatility. So the market, led by impactful volume, has these volatility cycles where volatility contracts, gets very, very quiet, and then explodes and gets very, very extreme. And then it reverts back to being quiet and then explodes back to extreme. In this law of cause and effect, that's what we're seeing. The more that we're in a consolidation, or what he calls a base, the bigger the move is likely to be when it comes. This brings us to law number three. The law of effort and result. In the law of effort and result, we're going to compare the effort, the amount of volume coming through the market, with the result, the price movement, to assess market intent. So in other words, if there's a lot of buying, then the market should go a long ways. If there's a lot of selling, the market should go down a lot. So if we look at the law of effort and result, if there's a lot of buying and it's not going anywhere, well, it's telling us that there's also a lot of selling. And so when there has to be a lot of effort to make the market go someplace, then the market is highly vulnerable to going the other way fast. So if volume or effort is high, but price barely moves, This may indicate what he calls absorption. This means the sellers are just taking it in. They're selling into that buying. So we're absorbing the buying. This is our chance to exit or get short. If volume is low and moves are big, then the market is imbalanced or thinly traded. In other words, people are not interested in trading at that price. So we can use the law of effort and result to be able to validate and or question a trend. Discrepancies between volume and price suggest reversals or fake outs. And this law is often used to spot exhaustion in the market or hidden accumulation and distribution. So those are the three laws: the law of supply and demand, the law of cause and effect, the law of effort and result. And they all play off each other. Supply and demand tells you who's in control right now. Effort and result tells you whether that control is genuine or fading. And cause and effect tells you how big the next move could be based on the past. And so these three can link together. These three universal laws are something that we use all the time in our trading. They derive patterns that we use. They derive frameworks for how we think and manage. And so understanding these three universal laws is critical for you to be able to really interpret price action and to use volume in your trading. Now, there's a lot more we do with this, but this is one of the places that we start. So now you're off and running. And you're off and running on what day? That's right, it's Tuesday. And it's not just any Tuesday, it's Trader Tip Tuesday, where I come to you with tips and tricks like today, talking about the three universal laws of volume that you can use to take your performance to an elite level. I will see you next week.